Warren Buffett strikes again. The Oracle of Omaha is upping his bet on Occidental Petroleum. Buffett boosted his stake in the energy giant to 25.8%, snapping up almost 4 million common shares, giving him a total of 228 million shares in the oil giant. Now, his total stake in the company now sits at about $14.5 billion. Well, it's been a gangbuster quarter for the U.S. economy. GDP rising by 4.9% during the third quarter, powered by the consumer that stands resilient in the face of inflation. Though soaring bond yields may have done some of the Fed's work for it, it's clear stubborn inflation has a ways to go before the Fed hits its 2% goal. So what can we expect from the Fed next week? Well, joining me now is John McClain, Brandywine Global Portfolio Manager. Good to have you on the show here. So give us your expectations here. I mean, we're about 18 months in of interest rate hikes and pauses here. What are the expectations coming into the next meeting?
Well, you hit the nail on the head with your introduction here. GDP is strong, the consumer is strong, inflation's coming down, but not as quickly as the Fed would like. I don't think we're going to see any surprises in the next meeting here. I mean, we're not hiking this time around, but I do think that there's potential for an additional hike to be coming into the market probably in December. And I think the Fed's going to have to talk tough at this point because the economy is strong, because equity markets, despite the recent sell-off, are still performing reasonably well. The Fed's got a lot of work to do here, and it's fighting fiscal stimulus as well at this point.
And in terms of the tools that the Fed is using, you noted that COVID didn't kill the U.S. economy. In fact, it structurally altered it. What does that mean then for the Fed's approach as it's looking at the strength of the economy at the moment and still in this high interest rate environment and inflation's still sticky?
Yeah, I mean, the Fed can't act alone in isolation, right? And I think, as we mentioned, you've got a cocktail of financial engineering, loose fiscal policy, stimulative government programs that have all been counteracting what the Fed's doing. And also, I don't think it's talked about enough at this point in time, but the Fed's balance sheet's massive. It's massive relative to GDP and relative to its historical positioning here, and that's still very stimulative. So the Fed used to have kind of the lay of the landscape, and monetary policy had a strong transmission mechanism. It's not the case today. They're fighting a lot of counterbalancing forces.
And, people are looking at their retirement, they're looking at their 401k, and the Fed does not care about your 401k at the moment. At what point does that narrative change, though?
Well, J. Powell, Scrooge McDuck, right? Like, yes, he definitely does not care about the stock market or the 401k. And I think that's a misnomer that a lot of people thought that the Fed stepped in March of 20 as the stock market was crashing. That was not why they came in at all. They came in to restore order to fixed income markets, particularly treasuries. You could not trade treasuries for a point in time, basically, during the depths of COVID. And that's what the Fed cares about. It's orderly financial markets. They don't care about the stock market. And really, we would be massively far away from a Fed put at this point in time.
And of course, I have to ask you about the action that we've been seeing with bond yields and the impact that's been having on stocks, that dichotomy there. What are your projections for where this goes from here? I mean, we're going to be in this holding pattern of higher for longer interest rates, clearly for the foreseeable future.
Yeah, and we said that, and this is a generational opportunity for investors to shift capital away from equity into fixed income. The relative attractiveness of fixed income compared to equity markets is as strong as it's been in 20 plus years. What we think is areas of the market that are relatively short duration are particularly interesting at this point in time. So we highlight high yield at 9.5% yield is forming kind of a Goldilocks opportunity for investors with low default rates, low dollar price of bonds, and high yields. The longer part of the Treasury curve is particularly challenging at this point. What we're watching closely here is where the 10-year closes. And if we close above 5% at a point in time, I think that could potentially lead to a real blow-off in back-end yields. We could see yields jump massively here. And what you got to pay attention to is the ineptitude of Washington, D.C. at this point. You've got politicians that, it takes 3 weeks and, 4 speakers to elect the new speaker. I think we're going to have to wait and see around fiscal discipline coming out of DC, because if we don't have that fiscal discipline, you could see a material rise in back-end interest rates.
And certainly, when you have a new speaker now who is, he's pro-Trump, and it's going to be a tough sell here to try and get some sort of, to avoid a government shutdown here. When you couple that also with what we've seen, as you mentioned there, with the inverted yield curve, when you couple that with a potential recession, then what are your recession estimates? How deep do you think it's going to be, and what could potentially change that narrative?
Well, look, we were early to a recession call in 2023, and I think, as we briefly mentioned, financial engineering and creativity from CFOs has really prolonged this cycle. And I don't think we're going to see a recession in the next 12 months here. So I think it's continued to be pushed out. But in terms of where we see bond yields going, again, the back end of the curve is relatively murky, but the front end of the curve is reasonably, if not particularly attractive.
And what else do you find attractive in this sort of environment? I know we talked about fixed income here. So what are some of your favorite picks at the moment?
Well, again, from an asset class perspective, we like to stay relatively short because the curve, while it's inverted, has gotten less inverted. So we want to take some duration, which means rotating a bit out of floating rate and into high yield. We find a lot of value in the mortgage market. Mortgages are exceedingly cheap, but they're cheap for a reason. Until the Fed comes in and buys, until banks buy, mortgages are going to remain relatively cheap. But if you're a buy and hold investor and you have a 5 to 10 year time horizon, fantastic opportunity there. Investment grade corporates are reasonable at this point as well. So there's a lot to like in fixed income. And from our perspective on the equity side of things, look, you're trading at 19, 20 times PE, and the cost of capital has gone up 500 basis points over the last 18 months. And so that cash flow is going to be servicing debt as opposed to paying dividends and share buybacks. So again, we think the relative trade is out of equity and into fixed income across a number of different asset classes.
And especially still in the thick of earnings season here, is that giving you any sort of expectations as we're looking ahead to the following quarter?
Earnings are coming in fine, right? Like I think when you look at the Magnificent Seven, some of the generals are starting to get shot here a little bit, but it's not based on the fundamentals of the business. It's based on longer term expectations as well as valuation. So I think what we're seeing generically is reasonable earnings from these companies. And what I would point to and why we're so constructive on corporate credit is the fact that these companies have had 18 months to figure out their balance sheets, and they're seeing rising interest costs, and they're not borrowing, which is fantastic and very supportive for debt holders. But earnings expectations, I think, are reasonable at this point in time. They're going to start to come down as we see the impacts of rising interest expense on corporate EPS, but it's going to take a lot longer than I think the market anticipates.
I'll certainly be watching that. Appreciate you taking the time to join us this morning. John McClain, Brandywine Global Portfolio Manager. Thank you so much.